Now, as I recall, the majority of retail investors, institutional investors, and major banks were very bearish coming into 2023. In fact, many of the banks, they kind of like forecasted that the market will keep going down for at least the first half of the year and only recover in the second half and maybe hopefully break even, that a recession was inevitable. But so far, the market has proven everyone wrong. It's been a bull market, like I called it since 15th of January. Now, I got a lot of hate from people saying that, Adam, how can you say it's a bull market? Everything's going wrong. Interest rates keep going up. And the war is continuing and corporate earnings are declining. How can you say it's a bull market? Well, very simple. If it looks like a duck, it quacks like a duck, it's a duck. And so I always believe in looking at the current price action of the market, looking at the market for what it is and not looking at it based on our biases and our filters that we get from the media, right? So again, if you look at where the market is right now, it is clearly in a bull market. Why? Because take a look at the price action. What do you see? You see a wave up, a wave down, wave up, wave down, and highly likely we're going on the next wave up. So you see the price action making higher highs and higher lows. So what do you call higher highs and higher lows? There's an uptrend. It's not a prediction. It's not my subjective belief. It's a fact, right? And as I said, on the 15th of January, the moment the 50 moving average, which is the blue line, crosses above the 150 moving average, which is the green line, and they both start flattening or sloping up, that has always been a very powerful bull market signal. Again, it's not 100%, but it's like over 90% accuracy if you backtest it for the last 20, 30 years. And so far, we have remained above the 200 moving average, which is this red line. Now, I mentioned before that we need the 200 moving average to slope up to increase the strength of the bull market. It's not done that yet, but the 200 moving average has already flattened. Now, of course, some people still believe that this is a bear market rally. It's not a bull market. It will likely fail and come back down again. Now, of course, I keep saying that everything is possible. No one can predict 100% what's going to happen in the market. Of course, it's possible, but at this point, it's pretty unlikely that's going to happen. Let me tell you why. Because so far, the S&P 500 has stayed above the 200 moving average for 29 days. Now, going back to 1950, over the last 70 years, this has never happened for a bear market rally, all right? So yes, there have been bear market rallies where the market went above the 200 moving average, but it was a fake out and it collapsed. It has happened before, but never for 29 days. In fact, the longest the S&P has stayed above the 200 before failing was 13 days. And that happened in 2002 during the dot-com crash. And this is 29 days. So again, the fact that it's been above the 200 days so long, it's pretty unlikely that it's going to go back down again. Again, not impossible, but pretty unlikely, right? And I found it pretty amusing because a lot of people were freaking out the last couple of weeks. Adam, why is the market going down? The bull market is failing. Why? It's not failing. Come on. Remember, I keep telling you guys this. In a bull market, in an uptrend, prices don't go up in a straight line. They don't go up every day, every week, every month. All right? It goes up and down, right? It goes wave up, wave down, wave up, wave down. It's going to go through wave downs. So when it goes through the wave down, instead of panicking, oh my God, we're going to die. During the wave down, you want to buy, right? You want to add shares in a wave down before the next wave up. The problem is a lot of people, they do the opposite, right? A lot of people, what do? When it drops, they, oh my God, and they sell there, right? They sell at the bottom and it goes up. Yes, it's going up. And they buy here, right? After they buy, it drops. Oh my God, we're going to die. They sell here. And then after they sell, it goes up. Oh my God, it's going up. I'm going to buy. They buy, it goes up. Oh my God, we're going to die. You sell. So most retail investors, what do? They sell here, right? They buy here. They sell here. They buy here, they sell here, and they always lose money. They always buy high, sell low. Now, how many of you have experienced this before? That every time you buy the stock, it drops. Every time you sell the stock, it goes up. Okay, have you experienced that before? Now, if you have, it's not because of bad luck. It's got nothing to do with luck. It's not because the market gods hate you. No. If you experience that, it's because your buying and selling is based on emotions. You buy when people get excited, you get excited. And by the time you buy, it has already run up. And when people panic, you panic and you sell. And you sell when the market bottoms. So again, if you want to make money in the markets, you have to train yourself to do the opposite of everyone else. You've got to look at the price action and make rational decisions and not based on news and emotions, right? And again, a lot of people, when the market went down, they read all the bad news. Oh, interest rates keeps going higher, the Fed's going to raise interest rates. They read all the bad news and they keep selling. If you want to make money from markets, ignore the freaking news. Ignore it. Or if you don't ignore it, take advantage of it, but don't be influenced by it. And ignore the emotions of the market. And not only ignore, but learn to go against and opposite of the emotions of the market. So let's see where we are right now. So far, since the start of the year, which was about there, the market initially ran up about close to 6% in the month of January, and February kind of like pulled back, right? After wave up, breathe out. You can't breathe out forever. You got to breathe in. You got to breathe in before breathing out again. So February was kind of like digestion, right? It was kind of like breathing in, and then now it has pulled back. It's time to make the next run based on the current price action. And what's pretty interesting is you can see the market can be pretty predictable sometimes. Sometimes, not all the time, right? So for example, if you take a look at how interesting it is. Sometimes I think that the world we live in is the matrix. It's kind of like we are living in a simulation because everything is like so mathematical, right? So we take a look at this wave up, right? Wave up to wave down. This was what we call the A, B, C pattern, right? A to B is the wave up, B to C is the wave down. And in this case, if you look at this B to C pattern, it was A, B, C. It bottomed at the 50% retracement level. Remember, usually the market tends to pull back to the 38.2% shallow retracement, 50% mid retracement, or 61.8% deeper retracement. So usually the 61.8 is the last pullback level, thereabouts, right? So this was a 50% level. And in January, we had the next run. A, B, and then we kind of like bottom last week at C. And was that a Fibonacci level? Yes, like I said, we are living in a simulation. This is really, really, really freaky, right? Tell me that the market's not manipulated. It's all freaking manipulated by some mystical market god, right? Okay, so you can see A, B, C, 61.8%, exactly reversed at that level. Now, come on, is that coincidence or is that some mystical market god? I don't know, right? But it works. Not all the time, but oftentimes the market follows these patterns. So when you learn these patterns, it helps, all right? So the market pulled back to the 61.8% Fibonacci level, and at the same time pulled back and bounced off the 200 moving average. So that's a very strong support level, and it closed with a bullish engulfing pattern. So again, you got all the stars aligned for a bounce back up. Like I said, there's no guarantee, there's no 100%, but likely it looks like we could be headed up right now. So far year to date, the market's up about 5%. So if you're holding to high quality companies in your portfolio, you should be up more than 5%. My portfolio so far this year, let me just kind of like bring it up. So far this year, let me just see. Yep, so far this year, my portfolio is up 14%. It was up actually 18% at the end of January, and then we had a pullback in February, so now it's up 14%, so it goes up and down, right? But hopefully, end of this year, my portfolio could end up more than 20%, all right? Hopefully, right? So right now, the market's up 5%, and my portfolio is up 14%. So if the market can go up by 15%, 20% this year, my portfolio could be up 30% or more this year. Again, no one knows, we can't predict it. Let's see how it goes. Now remember that if you want to follow my live portfolio and look at all my portfolio allocations and get live buy and sell alerts every single day when I buy and sell stocks as well as my option trades, you can subscribe to the Ultimate Investors Playbook, which you can find at insight.piranhaprofits.com. And you also get exclusive access to my private Discord channel where I post all my investments and trades in real time. Now, so far, year to date, the 3 best performing sectors in the market have been, number 1, consumer cyclical, known as consumer discretionary, like for example, Nike and Amazon and Booking.com and Mercado Libre. These are consumer discretionary companies. Second best performer, technology, your Salesforce, your Microsoft, and so on and so forth. And number 3, communication services have been the 3 best performers. Now, recall that last year, these 3 sectors were the worst performers. And if you recall what I said at the beginning of the year, during my outlook for the year, I said usually the worst sectors last year would be the best sectors this year because of mean reversion. And sure enough, so far, they have been the best performing sectors. And the best performing sectors last year, energy, utilities, and consumer staples are now the worst performing sectors this year, right? You can see so far this year, energy is down 0.46%, consumer defensive down 1.81%, and utilities down 6%. And again, that's a very common mistake that most investors make. Most investors, they tend to chase performance. They think, hey, last year energy did well, this year I'll buy energy, and they die. Or they say, last year technology didn't do well, I'm going to sell all my technology stocks. And once they sell all the technology stocks, it goes up. Okay, and that's why I keep saying that you have to always think opposite of everyone else. Now, what's pretty interesting is that one of my favorite sectors is healthcare. I love healthcare for a variety of reasons because the healthcare sector tends to be relatively defensive during recessions and bear markets. I mean, think about it. In a bear market, in a recession, you got to use healthcare, right? You got to buy medicine and, medical devices, right? It's recession proof. At the same time, healthcare is in a secular growth industry. So I got a good proportion of healthcare stocks in my portfolio. And what has happened so far this year is that the whole healthcare sector has been selling off. Now, you may ask, why is that happening? Now, there's no logical reason, just that sectors go through rotations. They all take turns. Sometimes healthcare sells off and tech goes up. They all take turns. And what I do as an investor is when a certain sector sells off and gets undervalued, that's when I start accumulating shares of the best companies within that sector. So for example, some of my favorite healthcare stocks like Johnson & Johnson, that has been selling off. Now bear in mind that J&J is not a high growth stock. It's a very low growth stock, but a very defensive company and very predictable company. And you can see this sell-off recently, right, dropping down. So again, this could be a great opportunity to pick up shares of Johnson & Johnson if you're looking for some healthcare exposure in your portfolio, right? You can see again, wave up, wave down, 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 wave up, wave down. Great time to add shares, in my opinion. But again, as I always teach people, don't buy all at once. You got to average in tranches. Another one of my favorite companies in the healthcare space is United Health. All right, so United Health, again, one of the higher growth and predictable defensive names, and recently selling off as well, starting to go near and hopefully go below my intrinsic value of 470. So it's not yet cheap enough, but these are the companies I'm watching for. Now, there are many others that you learn about again, my courses, in my subscription programs, but these are 2 that I'm looking at as well. Now, besides that, you could also look at ETFs for the healthcare space. For example, one of the main ETFs is VHT. This is the Vanguard Healthcare ETF, and you can see this support at the 150 moving average, right? You can see bounce off the support, bounce off the support, bounce off the support, and we could see a bounce from here. You can see on Friday, this actually closed with a bullish pin bar pattern on the weekly candle. So that could signal a reversal on the VHT. Another one of my favorite healthcare ETFs is IHF. This is a pretty high growth and defensive ETF that tracks the health insurance companies in the US. And you can see it's been pretty much consolidating for the last year or so. It's been a consolidation range. But before that, it's been on a very nice uptrend. So you can see that it's now consolidating near this support level, right? So I'm hoping it could go a bit lower down to this support over here, this previous low, where I could accumulate before the next run up. But we'll see how it goes. So after a very strong January and a negative February, what can we expect for the next 6 months and for the rest of the year? Now, I said before in my earlier Outlook webinar that I'm very bullish for this year because it's the third year of the US presidential term, which is usually the most bullish year in the 4-year presidential term. But I read this interesting post by Wayne Whaley, so I thought I'd like to share this. Credit to him for doing this research. And see, what he found was really interesting. When you get a very strong January, which is more than 4% return in January, which we got 6.18% this year, so that's considered strong January, then usually the next 6 months will be positive. And this has happened 100% of the time since 1950. It happened 21 out of 21 times. But what happens if February is negative, like we just experienced, right? So you can see his research over here that when January is very strong, which is 4% and above, and February is negative, what happens now? So far since 1950, this has happened 7 times. Strong January, weak February happens 7 times. And out of the 7 times, 100% of the time, the markets ended the next 6 months with a pretty strong gain. You can see 1958, it was up 17%, 11%, 2%, 8%, 22%, 6%, 5%, giving us an average return for the next 6 months of 9.97%. And this has happened again 7 out of 7 times. Now, again, you may say that's a small sample size. Yeah, it's a very small sample size. But I thought it's a pretty interesting piece of research as well. So what has been driving the market higher? I believe it's because the economy is just very, very strong. Everyone said a recession is inevitable. I don't think so. I think that the US may still avoid a recession because, again, the economy is bloody strong. Last month, we got US retail sales coming in the highest in 2 years. We had a jobs report showing that a total of 517,000 jobs were created in the US in January, which was way above the estimate of 187,000 jobs. Now, how the hell can you get a recession with 500,000 jobs being created in a month? It's pretty difficult, right? And the unemployment rate fell from 3.6% down to 3.4%. So the economy has been very, very strong. You can see that over here on the chart. Job growth has been spectacular. Wage growth has been growing, but at a slower rate, which is good for inflation, right? We want wages to grow. We want real incomes to grow so people keep up with inflation, but we don't want wages to be too strong such that it fuels inflation. So it's kind of like the best of both worlds. Now, of course, people are still very concerned about corporate earnings, right? So we know that the last corporate earnings that was announced based on Q4 2022 was negative. So corporate earnings have been declining. Companies' profits have contracted for the last quarter, right? In fact, you can see over here, for Q4 of last year, which was just reported, the blended earnings decline for the S&P 500 was minus 4.8%. This will mark the first time the index has reported a year-over-year decline in earnings since Q3 of 2020, right? So a lot of people say, hey, how can the market go up if corporate earnings are declining? Yes, they can, based on history, right? So you can see, for example, these were the top 10 bull markets that started from the bear market lows. You can see over here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So these were the 10 strongest bull markets in history since the 1950s, right? So you can see 2002, 1957, 1962, so on and so forth, right? Now, during all these bull markets that happened, did they happen when corporate earnings were growing? No, they weren't. In fact, you can see out of these 10 bull markets, 1, 2, 3, 4, 5, 6, 7, 7 out of 10 bull markets. That means 70% of the time when the market was going up, corporate earnings were declining. You can see, for example, in March 2020, when the stock market went up 75%, corporate earnings declined 15%. In March 2009, when the stock market went up 69%, corporate earnings declined 7%. All right. In fact, the top 4 strongest bull markets occurred during negative earnings per share growth. Now, a lot of people, they don't understand, how can this happen? How can the market go up when the company's profits are going down? It doesn't make sense. Yes, it does. Because remember that the market does not care what's happening now. The market doesn't care what happened last year. The market cares what happens in 6 to 9 months, because the market is the leading indicator of the economy. So the market always moves 6 to 9 months ahead of the economy, and the market tends to price in what everyone already knows. That's why when people think that how can the market go down when there's a war, when there's earnings decline, how can it happen? Because the market already knows that. You think you're the only one who knows that? No, everyone knows that. It's nothing new. And that's why the market can go up, right? So this was a lesson I learned myself after being in the market for so many years. I remember that, like 20 years ago, I had that thinking. I was like, how can the market go up when people are losing money? People are losing jobs, doesn't make sense. Then I realized that the market is not the economy. The market moves ahead of the economy. That's something you got to always understand as an investor. Now, I've got some people then saying that, but the market is so expensive, it's overpriced. No, it's not. No, it's not, okay? If you look at individual companies, yes, there are some that are way overpriced, I agree. But there are also many companies that if you do a discounted cash flow analysis of the individual companies, they're not expensive. In fact, quite a number of them are very undervalued. Want to know which ones? Join my community. Take the investing course, learn how to value companies. But even the market as a whole may look expensive, but not really. Let me explain why. Now, currently, the forward PE ratio of the S&P 500 is 17 times earnings. So is that cheap or expensive? Right? Well, let's look at history. Now, based on the last 5-year average forward PE is 18.5 times. So you could say the market is now cheaper than the 5-year average. But if you look at the 10-year average forward PE ratio, it's 17 times earnings. We're at 17.7. So you could argue that we are slightly above the 10-year average. So roughly, I would say if you just look at PE alone, we are not expensive. We're not cheap. We are kind of like fairly priced as a whole. But again, there are individual companies that I think are very, very cheap. Like I think Meta, Facebook is still damn cheap. Even though Meta has gone up like more than 50% this year, it's gone up 50% this year, right? It's still cheap, right? Alphabet is still cheap. Amazon is still cheap in my opinion. Now, what's interesting is that if you actually remove, and this research was done by Fundstrat, okay? If you actually remove the FANG stocks, which is the Facebook, Apple, Amazon, Netflix, Google, right? Now, these FANG stocks, they appear expensive because they have a high PE, right? But remember that PE ratio can be very misleading. They look like they have a high PE. For example, if you look at Amazon, the PE is like 60 times, for example. Looks expensive, right? It is not. It's because it's been distorted by an exceptionally low earnings. So for example, if you look at Alphabet and Meta and Amazon, their earnings per share for the last year have been exceptionally low. Why? Not because their revenue has been declining. In fact, their revenue has been growing for many of them, but earnings have been exceptionally depressed because of high R&D spending. They spend a lot of research and development, so when they have a lot more expenses, earnings get depressed. So it's not something that is a long-term, it's a short-term cyclical phenomenon. So once they kind of like cut back on their R&D growth or spend, which they are doing right now, and they're starting to cut back on excess headcount, you can expect that for these FANG stocks, the earnings would expand dramatically. And once the earnings expands dramatically, the whole PE will come down. So in other words, if you take the normalized earnings of Amazon, of Alphabet, of Meta, it's not expensive. It is cheap. It is very cheap. Okay. But anyway, if you take out the FANG stocks, you can see net of FANG, S&P net of FANG, the PE ratio right now is only 14.8 times earnings, which means the market is not really expensive. Okay, so very often you gotta look under the hood, you gotta read between the lines to get the gist of what's really going on in the markets. Now, finally, some people would argue, Adam, how can the market go up? Bloody interest rates are so high. When interest rates are so high, the market can't go up. Yes, it can. Yes, it can. How do I know? Look at history, right? Be a student of history. Now, how do you measure interest rates? You've got the short rate and the long rate, right? Short rate would be kind of like the Fed funds rate or the 3-month Treasury bill yield. The long rate would be the 10-year Treasury yield. So let's look at both the short-term interest rates and the long-term interest rates. Now, currently, right now, the short-term interest rate, the 3-month Treasury bill, is 4.84%. The long-term interest rate, the 10-year yield, is 3.95%. So is this considered high or low? Well, based on the last, if you compare to the last 10 years, it looks high, right? Because interest rates were near zero for a long time. Now it's like freaking 4%, 5%, high interest rates, right? Yeah, but if you look further back in history, you can see that in the 1940s, 1950s, 1960s, 70s, 80s, 90s, 2000s, and 2010, interest rates used to be very high as well. For example, you can see that in the 1970s, all right, 1980s, look at that, interest rates were 7 to 10%, 6 to 8%. But the stock market still went up. In fact, in the 1980s, the stock market returned an average of 17% a year, with interest rates at 8 to 10%. And right now, we're only at 4 to 5%. So yes, the market can go up even with high interest rates. Check this out, right? Interest rates were again close to 4 to 5% in the 1960s, but the market still returned an average of 7.7% a year. All right, so that could still that could happen. All right, so this has been a quick rundown of the markets. Hope you guys enjoyed it, and please subscribe for a lot more videos coming up. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.